Some of the big moves in the commodity markets of late have been generated by the dollar's move. Mining analyst John Meyer joins us now from SP Angel. John, welcome. And of course, it's not just from the dollar's perspective, it's from other currencies as well. So whichever way you look at this, I guess, there's going to be a currency impact. But what's the takeaway for those that like the idea of investing and trading in mining companies about the dollar's impact on what's happening in the commodities sector?
Well, I think the first thing to focus on is sterling, because that's what we buy our stocks in. And the weaker sterling gets, and it has been getting weaker because of the terrible Brexit word, then the more important dollar earners get. And mining companies are dollar earners. Almost everything is denominated in dollars. But at the same time, let's remember that they dig materials out of the ground, usually in other parts of the world, in emerging economies or in Australia, for example, where their currencies are moving around as well. Now, the dollar has been strong because US manufacturing was generally seen as strong, not quite so strong today with the PMI numbers coming out, but the US is still seen as economically better than many other parts of the world, particularly China, which is suffering with the trade war. Now, a lot of the world's commodities are denominated in dollars. They're all denominated in dollars one way or another, but they're bought by Chinese people. They're bought by Chinese traders and manufacturers and buyers, and they want to buy the stuff really in renminbi. So when the renminbi goes down, and the renminbi has been allowed to fall by the Chinese central bank, much to Donald Trump's horror, and he's labelled China as a currency manipulator, but they've allowed their currency to fall, and for them that means commodities have become more expensive. So they're saying, oh, we're not keen on the fact that the price has gone up in renminbi. They'll try and pay a little bit less, and what happens is the value falls in dollar terms. Now, a lot of that is offset by weakening the weakening Australian dollar, the weakening South African rand, and many other local currencies. So there's a bit of a game here. So for a UK investor, it's all looking pretty good. If you own a mining company, if you own Rio Tinto, BHP, or something like Bushveld Minerals, that's great because local costs have come down. But there is the offsetting factor that the dollar value of the commodities pulled back a bit as well. Now, if you're buying stuff that's dug out of the ground in Australia and South Africa, I think that's still looking pretty good. That's still a net benefit to you as a UK investor, and in fact is much better than owning a lot of other things in the UK which get their revenues in sterling terms.
Of course, there also has an impact as well, I know, on the operations generally of emerging markets, because emerging markets are so heavily dollar denominated in terms of their local economies, and this is of course where a lot of the stuff is dug out of the ground. Give us an example of a company where there is a play on the dollar that you know intimately. What should we look at in terms of some of the stocks to watch?
Well, the big stocks are the most easy to work out, Rio Tinto and BHP, Glencore to some degree. But for Rios and BHP, it's pretty simple. So much of their earnings are from iron ore now. Rios was into coal, but it sold a lot of it. But so much is iron ore that it's the combination of the iron ore price and the Australian dollar are important there. And of course, for a UK investor, that is providing great returns for you because of the dollar value of the iron ore that is being sold into China. If you look at the mid-cap sector, look at something like Bushveld Minerals, which is selling ferrovanadium, selling again mainly into China and Europe. And of course the South African rand has been falling, so that's a net benefit to the company. And of course sterling has fallen, so it's great from a UK investor perspective.
And of course the dollar's move also has an impact on the price of the metals themselves, doesn't it?
Yes, and there was a big move on Monday where the price of platinum corrected very sharply, about $50 an ounce. But it was in thin markets. It was the Jewish New Year, and the Chinese were on holiday for their anniversary celebrations. But platinum, of course, was ready for a fall. It was primed because palladium is of greater value in gasoline engines right now, and people are buying less diesel. So it's very easy for the buyers of platinum to say, oh, I don't think I want any more of that today. We're not selling that many diesel vehicles. And so the platinum price came crashing back, full $50, nearly 6%. Silver got dragged down with it. It got dragged down about 3%. Gold as well by 2%. But then gold has recovered, and in fact has recovered more than what it lost there. So really this was more of a platinum-inspired fall in thin market conditions.
Yeah. Okay, so from your seat as a mining analyst, what are you telling clients at the moment then? Not necessarily about the dollar story, about the foreign exchange markets, but how comfortable you feel with exposure to commodities and commodities companies at these levels?
Well, yeah, it's tough times for some of the companies with the base metals prices and some of the industrial metals prices pulling back. Lithium has also been hit particularly hard with the Chinese government and other governments pushing out or pulling back on the subsidies for electric vehicles and effectively meaning that the demand is not quite there. And the industry is playing catch up from an electric vehicle manufacturing standpoint to give a bit more breathing room for the new battery factories to get going and catch up. And some of these guys are adjusting the chemistries that they're using in their batteries. So, for example, Tesla is going to use a nickel-rich chemistry for its new batteries in Shanghai, and they may also go on to that in America at some point. I hear other battery manufacturers are looking at going for a more nickel-rich technology, so slightly less cobalt, slightly more nickel, a bit of manganese in there as well, and probably a few other bits and pieces. Again, look to watch what's happening in rare earths. I think an increasingly important market, particularly with growing electric vehicle consumption. Interestingly enough, that whilst there was a pullback in electric vehicle buying, it hasn't pulled back as much as some people might have feared. So yes, there's loads going on in the sector. It's a bit tough if you're just producing copper, for example, but people are still making money out of it, so it's not a bad place to be.
Part of that, though, I guess, is the fact there's a deficit, isn't there, in the copper, there's an approaching deficit in the copper market, so the lack of mines, I guess, is holding the price up as much as anything.
Hard to find people in the industry who don't see a deficit on copper, so yes, we're all wondering, where is the next generation of copper mines going to come from? We're seeing the majors are very busy signing CAs, signing agreements with junior explorers to say, we'll pay for that exploration program over here. We want to have a piece of the action. They've all moved into Ecuador following SolGold. They're moving into the Ivory Coast following Iron Ridge, both companies that have come out of the DGR stable in Australia. So these sorts of companies that are busy exploring, quietly exploring, are actually becoming really important, I think, going forwards.
Okay, all right. So, John, thanks so much indeed for joining us. John Meyer joining us there from SP Angel, where he is a founder and partner at the company and also mining analyst.